took out the 20-day early this week, and now it's a little bouncing again as we record this on Thursday. But what if the dollar index now just continues down because all this profligate spending and no debt reduction and, concern, maybe Japan comes in and sells treasuries because they got to support their own bond market. So they sell treasuries, take those dollars, sell those dollars and buy yen so that they can go support their own bond market. What if the dollar index goes back down to 98 and then keeps falling over the next couple of months? Goes to 96, 95. Think gold's not going to rally? Of course it is. Like I said, the last time it was at 98, gold was 3,800. So I think, or 3,500. I think what's coming over the next couple of months is going to catch a lot of people by surprise because, again, they think it's just a dot on a screen. It has to correct. It's got to pull back. It's overbought. It's a crowded trade. And when it goes to 37 or 3,800 over the next 2 months, it's going to catch everybody by surprise. And then, and then it'll be due for another pullback.
The U.S. dollar index has weakened and could keep falling due to excessive government spending and rising debt. Last week saw the U.S. dollar go oversold on the weekly chart for only the second time in the past 7 years. That low on Friday printed right around a key Fibonacci level at 98.98. Gold is likely to rally if the index drops to 98 or lower. Many investors still expect a gold pullback because they see it as overbought. Still, the speaker believes gold could surprise everyone by surging to $3,700 or even $3,800 in the coming months before any meaningful correction. A recent note from ECB economists quietly raised serious concerns about the gold derivatives market, echoing warnings long voiced by gold market observers. The note highlighted risks stemming from extreme leverage in futures and forward markets, where one physical ounce of gold can be rehypothecated multiple times, creating far more digital claims than actual metal. The ECB also noted that, over the past 30 years, gold has outperformed equities, the US dollar, and bonds during periods of stress. However, the research shows that gold performs best during heightened geopolitical risk or elevated economic policy uncertainty. The ECB's acknowledgment, though understated, adds legitimacy to long-standing concerns. Central banks can't print gold, and it can't be conjured out of thin air, says Russ Mould, investment director at stockbroker A.J. Bell. Combined with U.S. debt downgrades, surging long-term interest rates, and continued deficits, the message is clear. Physical gold demand is rising, and systemic stress in the gold market may be closer than many think. The speaker, Craig Hemke, also known as Turd Ferguson, is a seasoned precious metals analyst and founder of TF Metals Report. He explains that the gold and silver markets, especially silver due to their smaller size, are heavily influenced by leveraged financial structures rather than direct manipulation. During a recent silver-focused webinar, Sprott founder Eric Sprott, former Hecla Mining CEO Phil Baker, and technical analyst Michael Oliver joined host Simon Catt of Arlington Group to unpack what's driving silver's sluggish performance. Baker pointed out that solar currently makes up 29% of silver's total 1.2 billion ounces of annual demand and noted that if that were to disappear, it would have a massive impact on the silver market. However, he also said that even if there were a significant policy shift in the U.S., there would still be considerable demand for solar worldwide. Even in the U.S., the policy is all of the above, all forms of energy. So, I'm not concerned about solar cells diminishing. Could they go flat? Yeah, that's fine. Flat at 300 million ounces? That's great demand for silver, he added. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
You were saying actually that they reported that there could be more paper ounces than physical ounces there available?
Yeah, that's what they're alluding to, is that there's counterparty risk. And that counterparty, these big banks have this massive exposure against higher prices because of the way they manage their books, and that actually is a threat to the financial system. I mean, these are all things that, again, I'm like reading this going, so we'll say just that, what it reminded me of, because gold, there are a lot of things that have been driving price higher this week, right? The downgrade of the U.S. debt late last Friday after the markets closed, spiking long-term global interest rates, this passage of this big, beautiful bill that doesn't have any deficit or debt reduction at all. People thought, austerity and, they're going to balance the budget and Doge and all that's out the window. Okay, and so there's a realization now that's building that all that is out the window. And that's what the bond market is seeing that. So there's a lot driving price this week. But when I saw that, and I've seen the rally since, it kind of reminded me, remember back in about Valentine's Day, Elijah, there's that article that appeared in the Financial Times about delivery delays in London. Remember that one? And We already kind of knew this was happening. There's this big wide spread between spot and futures, and metals going all over the place. And they're talking about it was related to tariffs allegedly. But when it got codified, if you will, other mainstream sources kind of off guard. Like, wait a second, I had no idea. How is this happening? We didn't know this, but here it was, the Financial Times. And I kind of thought, in a similar sense, that's what that ECB note was. I mean, a lot of us, that follow gold intently and discuss it, and have for years, talk about that risk because it's a fractional reserve system. And the risk that if you just keep deleting the physical, what did China import last month officially? I mean, unofficially, because it's all mainly, through shades. It's not China's buying the PBOC. It's just everywhere. It's like 100 some odd tons. If you keep taking all this metal out from underneath the system, it forces a deleverage. And so anyway, like I said, I think that ECB note was just kind of a slap in the face, kind of like that article in Financial Times was. And that's kind of helped spark all part of what was driving gold higher this week.
Does this really confirm what a lot of, you've been talking about for so long about manipulation in the markets? Is this what the ECB is kind of alluding to? Is this actually precious metal manipulation, or is this different from any other commodities or what happens in any other commodities here?
It's pretty clear to me watching this stuff for 15 years, that there are hands that move price at certain points, both up and down. I mean, you can go back a couple years ago when the banks were actually getting net long in silver, and it was the hedge funds that were short. And you can see these things because, especially in silver, where it's a tiny market. But I don't think, in this case, I don't think that's what we're driving at, Elijah. It's just the structure that the banks have, in their vaults, whether they hold it themselves in London or for somebody else, and then they hedge that, right? That's what everybody says. They hedge that on the futures market versus a physical position in London. At the end result of that, how many times have those same ounces in London been hedged and sold forward? Because again, the London tries to tell you they got all these tons, in their float. And what saved them back in March? Well, central banks coming in and leasing gold in the market. Well, then how many times has this happened in the past? And how many times have those ounces been released?
The speaker discusses silver's recent price consolidation between $32 and $34, similar to a pattern seen earlier in the year. A key technical indicator, the 20-day moving average, is close to crossing above the 50-day, which previously triggered a strong rally when paired with a weakening dollar. If silver breaks above $34 and holds along with that bullish crossover, the speaker anticipates a move to $35 to $35.50 and potentially up to $38 to $39. The silver market is still facing manipulation. Addressing manipulation, Sprott suggested silver has been manipulated for the last half-century. I look at silver as a market manipulated for 50 years. We have about 8 to 12 major international banks short over 500 million ounces of silver on the COMEX, have always been short that product, he said. Craig Hemke explains that silver tends to stay range-bound until it breaks out. At this point, momentum builds as traders and institutions rush in, creating a self-reinforcing rally, just like in 2011 when silver surged from $18 to $48 in about 100 days. He believes we're seeing a similar setup now, with silver potentially breaking above key levels like $35 and finishing the year around $37 to $38. However, for silver to reach much higher targets like $80 or $100, it would likely require a significant technical event, such as a breakout on the annual chart, which could attract considerable institutional interest and kick off a powerful long-term rally, possibly next year. Now, let's get into the interview.
Pyramid of derivatives on top of it, futures contracts and forwards contracts. And as you shrink that supply, it just stretches the leverage even farther. And it's like remember when I wrote my macro cast this year, and we always do a call and talk about, what was in there. And I always tell you, I write those for myself so I can go back at the end of the year and go, what did I get wrong? In 2024, I thought, well, gold will probably go to 2,300 or so, maybe 2,400, which was still going to be a good year, but it just kept going. And now it's continued to go this year. And I thought, what did I miss? I think the main thing I missed, and this is noted in that ECB piece from earlier this week, central bank demand and constantly being on the bid is depleting that Western supply that underpins that system. It's what, 34 or 3,500 cumulative tons of net demand from central banks in 22, 23, and 24. Other banks be paying attention to this so they don't get caught flat-footed if, within that, this counterparty daisy chain of all their different obligations, that there aren't stresses coming for the banking system there and here.
And you mentioned how if you just look on a technical level, maybe where we'd be headed for a pullback here, but maybe things have fundamentally shifted. If, the banks are, if it's true that the banks are, short and that gold has been rehypothecated, and we also see just China accumulating so much gold at this point. So your thought is probably things have fundamentally shifted here.
Right. That's the thing. That's what the TA, and just the regular, professional traders and stuff are missing. It's not just a dot on a screen. Okay. It's not just, the scroll across the bottom of the screen price that you see on CNBC. It's this physical commodity that underpins all of those futures that are used to determine that price. That's what's getting depleted. That's what's becoming more and more scarce. And the demand for that physical commodity is what's doing it. And so when all these folks are sitting there, and they come up with all these, it's like all this discussion last month about, or even earlier this month, I guess, it's a crowded trade. No, it's not. I mean, by what definition? I mean, even the most recent surveys we see, 5% of all financial advisors have their clients with even just a tiny position in the precious metals. How is it crowded? Even by the Commitment of Traders reports, as of last week, we had the smallest cumulative speculative long position in gold since February of last year, before price even broke out. So how is it crowded? Or is it crowded because, price is in the 3,000s, so it must be crowded? You know what I mean? Are you trying to talk it into it's overbought. Well, by what measure? The monthly RSI maybe, but everything else, especially after the pullback, is not overbought. So what I think is going to happen now, gold rallied like crazy as the dollar was falling. From February 1st until middle of April, I think it was April 22nd, it bottomed out at about 98 on the dollar index. That day, gold hit 3,500. Well, then it bounced. The dollar, inevitably, it's not like the dollar index is going to zero. There's going to be bounces. It got up through its 20-day. And on my side, we're like, okay, now we'll watch because it's going to go to its 50-day. And there's all kinds of resistance at about 102, where the 50-day moving average was, a downtrend line, horizontal resistance, all that stuff. And it's exactly where it failed. And it rolled down, never got above the 50-day, took out the 20-day early this week, and now it's a little bouncing again as we record this on Thursday. But what if the dollar index now just continues down because all this profligate spending and no debt reduction and, concern, maybe Japan comes in and sells treasuries because they got to support their own bond market. So they sell treasuries, take those dollars, sell those dollars, and buy yen so that they can go support their own bond market. What if the dollar index goes back down to 98 and then keeps falling over the next couple of months? Goes to 96, 95. Think gold's not going to rally? Of course it is. Like I said, the last time it was at 98, gold was 3,800. So I think, or 3,500. I think what's coming over the next couple of months is going to catch a lot of people by surprise because, again, they think it's just a dot on a screen. It has to correct. It's got to pull back. It's overbought. It's a crowded trade. And when it goes to 37 or 3,800 over the next 2 months, it's going to catch everybody by surprise. And then, and then it'll be due for another pullback.
Now, we've been talking a lot about gold here. What about silver? We do see, a huge gold silver ratio, 100 to 1 right now. Your take on that? And at the same time, we still see strength in silver. It seems like holding up above that $30 level, and actually 32 seems to be pretty good support as well. So your perspective on that?
Yeah, it's been in a box for about 5 weeks between about 32 and 34. And this happened as well back in, I think it was February, and it was in a box, a $2 range for about a month.
Finally, Craig Hemke makes a strong argument for a possible spike in the price of gold and silver due to technical patterns, deteriorating dollar fundamentals, and rising systemic risk in the highly leveraged precious metals markets. Central bank purchases and structural imbalances in gold derivatives could trigger notable increases, particularly if essential breakout levels are exceeded. Short-term volatility is still present, but the long-term picture is optimistic, especially if institutional interest quickly responds to technical breakouts and macroeconomic pressures. In your opinion, will central banks sustain demand for physical gold despite price increases? Which technical indicators do you prefer to watch when determining whether to enter or leave a precious metals trade? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.